the narrative started that the Fed were going to tighten. They changed the dot plot, and that started flattening the curve, as it should do. But it kind of flattened a bit faster than people expected, which kind of suggested that the market wasn't sure whether the Fed could do this. And I've been eyeing the CESI, the Citigroup Economic Surprises Index, and started noticing that it was about to cross zero. Usually it trends, and we will see longer than expected weaker data. So if we're getting weaker data, then the bond market is probably telling us that we have a growth surprise, potentially to the downside. And the dollar tends to be a beneficiary of a low growth environment. It's not a rate-driven story, and the dollar rarely is a rate-driven story. So we're seeing real yields falling again, which has been helping gold, but gold has been trapped by the fact that the dollar is going up, and that makes gold quite unattractive. So it's kind of caught in these headwinds a bit. So what's interesting to me now is starting to see the data suggesting that the bond market is onto something. And it's the data that you talked about. Retail sales now are comping against the worst of the worst period of June, as are inflation numbers. But we've had real rises in goods, and they've been rapid, house prices. And we're seeing consumer confidence in all of these fall. So suddenly we're seeing confidence in purchasing cars, confidence in purchasing houses. All of these forward-looking indicators are falling because the price has gone up too fast that people are like, whoa, I need to stop that. Builders stop trying to build more property because the lumber price, okay, that's come off a lot now. But this is what often happens early stage after we're coming out of a recession. We have this fear that inflation's coming back. It's happened every single time since 1962. Bond yields rise, everyone goes, oh my God, it's inflation. And what generally happens is the stimulus rolls off and the economy doesn't have traction yet. And that usually happens 2 times. The Fed actually usually eased twice after the end of a recession to allow the economy to get traction. And then eventually it stabilizes and the Fed can think about normalizing rates. I don't think they will. I think they proved last time that they can't, and the debt burden's just gone up. But we get to that more stable point in the cycle. So this point in the cycle here is normally when you see everybody check their assumptions. You often get a VAR shock in equities, equities sell off sharply because, oh my God, growth's not there. Bond yields fall significantly. Usually they go to new all-time lows at this stage in the cycle. Does that happen this time? I don't know. And usually stimulus starts coming back on the table. Now, the political paralysis in the US might mean that it's hard to get across, and the bond market's not going to like that. If stimulus isn't coming, bond yields will start dropping further until stimulus comes, the QE comes back, then bond yields rise again, and we go through this cycle for a while. So look, it's a really interesting macro time. We're not 100% there yet, but we're close. Bond yields was the first thing to move. I'm next waiting for the dollar to make its move.
Raoul, it's interesting. I can geek out on the data, but you find the narrative. And that's the reason why I enjoyed these conversations with you so much, figuring out ways of pulling together all of this somewhat discordant data, discordant information into a coherent narrative. To that point, let's set up a clip, which I think you just did so well, from a conversation that you had with Julian Brigden on Insider Talks. This is on Real Vision's Pro tier. Let's take a look at the clip.
I've been kind of using my kind of business cycle framework, and I think I've talked about this before. For me, and it's yet to be proven out, but for me, every recession, we come out of it, bond yields rise too fast. They then come off, the central bank stimulates twice, and then eventually things settle down and we get to the proper growth inflation cycle. Felt like that could be playing out again, and that's why I've been kind of flagging that chart of bond yields, which broke.
So you're thinking we're going to get the second central bank easing, or have we had it already?
No, I think we're going to get it.
Yeah.
So I think we're going to get another round of easing, maybe towards the end of this year or next year, and that's including fiscal stimulus.
So there it is, Raoul, precisely the same points that you were making, the framework for your understanding of what's happening right now.
Yes, and that's a framework I've been building in both Global Macro Investor and Macro Insiders, which is Macro Insiders is part of the Real Vision Pro tier. And Julian and I have had a disagreement for a while about the stickiness of inflation and how this plays out, which has been tremendously valuable. He nailed a lot of this commodity moves and the reflation moves. And we've started, I think, transitioning to this growth scare. But the thing I want to focus on is my job is to live in the future, not just comment on what's going on today. That doesn't add any value to anybody. How does this play out? So if I'm wrong, and that this is just a repricing based on the dot plots, fine, then we shouldn't see a great deal of difference to the dollar. A lot of this won't set off, and we just continue as normal, which is continue with the reflation trade somewhat. It may be subdued. But let's say I'm right. Okay, that's why I'm interested, is there is a better macro opportunity within this, because living out into the future, if we are going to have a growth slowdown sometime in Q2, Q4 or Q1, the Fed stimulus and fiscal stimulus will be on a table, back on the table. Now, what's great about that is if you're a macro guy, you now know the outcome. The outcome is weaker growth stocks start going up. Weaker growth and then stimulus, well, that's like hyper stimulus for crypto. It starts lifting gold out of its linkage with the dollar. So it becomes pretty useful for that. Value tends to underperform over that period. Then, as the stimulus starts kicking in, we get that switch again, where value starts to outperform growth at the very end of that. Bond yields start rising again. So this whole framework should repeat itself a couple of times and is immensely tradable. For me, I'm more interested in the growth and wealth, kind of store of wealth side of the equation, which is gold and crypto plus the growth stocks, because I think that the relative outperformance over time in these trades is much higher, just because of the network effects of these and the increase in the size of the central bank balance sheet. So that's interesting to me. And so I think we're setting up for a very interesting back part of the year. But macro moves slowly, and people forget this. We get one data point a month. You might get some weekly data, but economies don't move like markets do. So most of the market moves are noise. You have to filter out that noise, and creating these narratives where you can test a hypothesis are really the best way of doing that.